Hi, today's topic is the price you should never pay. Quite clearly, the price you should never pay is the one where you cannot get your money back. Now, in order to value any business, we should visit the business valuation worksheet, which covers tangible assets and intangible. Tangible assets such as stock and plant and equipment can be sold and converted to cash at any time, with some exceptions. Specialty equipment such as a slipway or a service station business cause problems in recouping that money. But generally, it can be recouped through depreciation and you can get your money back in 3 to 5 years. So the only risk area in business is the amount paid for goodwill. This is an intangible asset and must be amortized over the economic life of the business. Let's suppose you pay $200,000 for goodwill and the business begins to fail in the 3rd year. The simplistic way of working this out is if you have made $50,000 residual profit over 3 years, you have received back $150,000. If the business fails, you will have lost $50,000. Now, we are not at this stage going to consider compound returns. Therefore, it's best to consider what you need to receive or estimate what you will receive if you rate the business as a 3 or 4 year exercise. This type of thinking will prevent you from paying too much for goodwill in the first place. Estimating economic life risk rates in the beginning will prevent you from making a loss. The next thing we need to discuss is the market value line. If you are going to buy any asset in the world with the hope of reselling it and to get your money back and make some margin, you must know where this market value line is. If you keep paying premiums, in other words, paying over the market value line, you will never get your money back. In fact, it will only be a short time before you go broke. Now, unfortunately, there are many people in the marketplace that pay premium above the market value. In fact, there are some that'll pay 10, 20, even 50 times more than market value. I should make that 50%. Now, I call these people emotional buyers, and it appears that the only ones that will pay well over market value line are people who spend other people's money. I would like to make a very clear distinction between property assets and business assets. You must know which class of asset you are dealing with. Property assets are reliable. They can't be stolen. They're cheap to insure. In fact, they're highly desirable. Mark Twain once said, "Buy land now, God's not making any more." Whereas business assets are not reliable and revenue streams can disappear overnight. Now, the third matter that must be considered at this junction is the implication and detrimental impact of taking over an existing lease. Now, if you look at the face rental, and it's much higher than market, if you take over that lease, you will be harming yourself and destroying your future. Then we look at lease term. If the lease term is too long and the business fails in the interim period, you will still be responsible for the rental, which may be more than the value of your tangible assets and will wipe out any chance of you recouping the amount paid for goodwill. That concludes today's presentation. Hopefully you'll get the book. Thanks for listening.